If you're self-employed or a business owner or a freelancer, renting can be an uphill battle, and owning your own home might seem impossible. Well, I'm here to tell you that you have options. Today, we're going to be talking all about bank statement loans, and this is a product specifically made for self-employed individuals. I'm Hannah Escher. I'm a mortgage advisor and rookie investor with 2 properties of my own, and I'm so excited to talk to you about bank statement loans today. All right, let's dive right in. So what is a bank statement loan? Well, a bank statement loan allows you to qualify off of the cash flow that comes in that shows on your bank statements versus using your tax returns to qualify your income. Now, if you're self-employed, traditional financing has to use your tax returns and has to use your profit margin to look at what your qualifying income is going to be. Now, here's the problem with that if you're self-employed. Many times, the perk of being self-employed is all of those tax write-offs you get to take. I know. I used to be self-employed myself, so I know how hard this can be to decide, do I take the write-offs or do I show more income so I can qualify for more? This is where a bank statement loan comes in. Usually, a lender is going to look at the last 12 to 24 months of your business bank statements to see what your cash flow numbers look like. So you're really getting to use a gross income calculation instead of a profit calculation. This can be a huge deal if you're self-employed. So once that lender takes a look at that 12 to 24 months of bank statements, many times they're going to do a standard 50% expense ratio. Now, this ratio can be moved around depending on your business and depending on if you can get verification showing that your business actually requires less than 50% expense ratio. Many times though, in my experience with this product, most self-employed individuals are going to be using that 50% expense ratio because that's going to be lower than what your write-offs are actually giving you versus your gross receipts. And this is where this product shines. It allows you to use these numbers that are closer to your gross receipts than that profit margin. Now, bank statement loans, they're not backed by Fannie Mae and Freddie Mac. So lenders can have many different layers of requirements that come with these types of loans. They are specifically for self-employed borrowers. And most of the time, you're going to have to prove that you're self-employed, either with some type of statement, paperwork that they provide you, or some lenders are going to require even that you have a letter from a CPA to state that, yes, you are self-employed. It shows that on your taxes for the past however many years. Bank statement loans usually do also have a requirement of how long you've been self-employed. Many times that's going to be 2 years or more. Now, some might even require that you've been self-employed for 5 years or more. So this is something to keep in mind. This is still a product that has regulations, guidelines, and requirements, just like traditional financing. However, the goal is to help increase that qualifying income so you can get a larger loan, which means you can purchase a more expensive property. Something else that's unique about bank statement loans for self-employed borrowers is that you can actually add other borrowers onto the loan who are not self-employed. Many lenders offer this option. So let's say you're self-employed, but you have a spouse or you have someone else who's co-signing with you and they're not self-employed. Most of the time that can completely work out. So you want to be looking at whatever situation is going to get you the highest qualifying income numbers so then you have the most options possible. Now, bank statement loans are offered through private lenders. So again, there's going to be different requirements depending on the lender you go through. Some lenders might have a requirement of how many acres your property can be on. Some lenders might have requirements around how many units you can borrow on with this type of loan. So you want to look at the different individual lenders' requirements to see which one might be the best fit for you. Now, bank statement loans, even though they're not backed by Fannie Mae and Freddie Mac, they still offer great terms. Most bank statement loans are going to come as a 30-year fixed option. They're going to have competitive interest rates, and they'll have pretty good down payment options available to you as well. Many times, the terms are going to depend on your credit score. So the higher your credit score is, the better terms you'll be able to get. In my experience, a higher credit score will many times give you lower down payment options. They'll give you a better interest rate as well, and maybe more options on buying that interest rate down. So having a high credit score can still be really important with this loan product. Now, let's talk about down payment requirements, because again, this is not a product backed by Fannie Mae and Freddie Mac. So what does this even look like? Most bank statement loans are going to have a minimum of 10% down, with many having at least 15 to 20% as the requirement depending on your credit score. So again, the higher your credit score, usually the lower down payment you're able to put down. Bank statement loans are also going to have a debt to income ratio requirement, and it depends, again, per lender, what that requirement might be. However, most of them do follow Fannie Mae, Freddie Mac guidelines and usually end at about a 50% back-end ratio. But you might find some that are stricter and have a 43 to 45% back-end ratio. So this is where you want to speak with your mortgage advisor and see what options might be available for you for your specific situation. How do you know if this is a good loan product for you? How do you know if this might be the right option versus going with traditional financing? Well, an easy way to figure out if this could be a good product for you, look at your tax returns, see what your gross receipts are versus your profit margin. If your profit is way, way lower than what your gross receipts are, this might be a good product for you to explore. If your gross receipts and your profit are pretty close, then I'd say traditional financing still might be the best option for you. Again, this is where working with a trusted mortgage advisor is going to be very important, because you want to be able to get pre-approved for this product just like you would with a traditional loan. That's it for today. Hopefully, bank statement loans helped you realize you may have more options than you previously thought. Thank you so much for your time. I'm Hannah Escher. You can search my name on BiggerPockets. And if you found this video helpful, like and subscribe to the BiggerPockets Rookie channel for more videos just like this.